Let's talk about the closing entries and why accountants record them. At the end of each accounting period, the general ledger must be prepared for the next accounting period. We call that the closing process. And there are 4 steps or tasks that accountants must complete to close the ledgers for any accounting period. Why do accountants close the ledgers? We spend all this time setting up all these accounts and posting to them, so why are we not closing them? It's important that accountants be able to report on each accounting period separately, rather than commingle the numbers with another accounting period. However, we won't close all of the accounts, only those that are temporary accounts. Do you recall what temporary and permanent accounts are? Temporary account is an account that begins each fiscal year with a 0 balance. At the end of the year, its ending balance is shifted to a different account, ready to be used again in the next fiscal year to accumulate a new set of transactions. Temporary accounts include revenue and expense accounts and owners' withdrawals and dividends. So what are those 4 steps? First, we'll close all revenue accounts and those income statement accounts that have credits to an account called income summary. Step 2 is to close all expense accounts and all other income statement accounts with debits to the account income summary. We close the income summary account to the capital account, and then we close the owner's withdrawals and dividends to the capital account as well. After the closing entries have been posted, the capital accounts reflect the results of the operations for the period. So let's look at the process step by step. Step 1 of the closing process involves closing out all revenue accounts and any other income statement account with credit balances to income summary. There's only one income statement account that is a revenue account, and we don't have any other credit balances in our income statement. So let's close out the fees income account, which has a credit balance of $47,000. How do we close out the account? We debit the account for $47,000. And what account do we need to credit? That's right, income summary. And there you have it. Let's write that journal entry into the general journal. The first step is to write closing entries on the first line, followed by writing the date on the second line into the date columns. Next, we'll write fees income into the description and the amount of $47,000 into the debit column. On the next line, we slightly indent and write income summary into the description column and the amount of $47,000 into the credit column. We're now ready for step 2 of the closing process. Step 2 of the closing process involves closing out all expense accounts and any other income statement account with debit balances to the income summary. There are 5 income statement accounts that are expense accounts. So let's close out the expense accounts, which all together add up to $13,333. So how do we close out the expense accounts? We debit income summary first for $13,333 and then credit each expense account. So let's write that journal entry into the general journal. We'll write the date into the date column, and next we'll write the income summary into the description and the amount of $13,333 into the debit column. On the next line, we slightly indent and write salaries expense to the description column and the amount of $8,000 into the credit column. On the next line, we again slightly indent and write utilities expenses into the description column and the amount of $650 into the credit column. On the next line, we'll write supplies expenses and a credit of $500, followed by rent expense and $4,000 on the next line. And lastly, we'll write depreciation expense equipment on the next line and a credit of $183. That's it for step 2. So we're now ready for step 3 of the closing process. Now that we've cleared the income statement and moved all revenue and expense accounts to the income summary account, we need to determine the balance in that account. Why? Well, it's an additional check that the amount is our net income, and we can compare it to our worksheet to ensure that it is the same amount. In our case, we have a balance of $33,667, and it's the same amount that we had on our worksheet. We're now ready to transfer that amount to the owner's capital account. We debit income summary first for $33,667 and then credit the Trayton Eli capital account. Let's write that journal entry into our general journal. We'll write the date into the date column. And next we'll write income summary into the description and the amount of $33,667 into the debit column. On the next line, we slightly indent and write Trayton Eli Capital into the description column and the amount of $33,667 into the credit column. The last step in our 4-step closing process involves closing the last temporary accounts, the drawing accounts, and the dividend accounts to the owner's capital account. We only have a drawing account with a debit balance of $5,000, which we need to close out to the owner's capital account. We debit Trayton Eli's capital and then credit Trayton Eli's drawing. Let's write that journal entry into the general journal. We'll write the date into the date columns. And next we'll write Trayton Eli's capital into the description and the amount of $5,000 into the debit column. On the next line, we slightly indent and write Trayton Eli's drawing account into the description column and the amount of $5,000 into the credit column. There you have it. The 4 steps of the closing process include: first, closing the revenue; 2, closing the expense accounts; 3, closing income summary; and 4, closing the drawing accounts. The next step is to post the journal entries into the general ledger.